If you've been thinking about getting started with investing, chances are you've also been feeling overwhelmed. Maybe you've managed to save a little money, not enough to buy a house yet, but enough to start wondering whether that money should be doing more for you. Then you open YouTube, social media, or Google, and suddenly you're hit with a flood of options. People are talking about stocks, shares, equities, government bonds, corporate bonds, real estate, foreign exchange, crypto, NFTs, futures, fine art, and even watches. It looks like everyone has a different opinion, and somehow all of them sound confident. On top of that, the fear kicks in. What if you invest at the wrong time? What if the market crashes? What if you lose your money you worked hard to save? What if you choose the wrong platform, the wrong strategy, or the wrong asset? If that sounds familiar, you're in the right place. Welcome to Doxalin, and my name is Daisy. At Doxalin, we talk about financial strategy, saving tips, and leadership. And in this video, I want to give you a clear beginner-friendly roadmap to invest in without the hype, without the confusion, and without pretending it's magic. We're going to break down this into four major sections. First, we'll talk about the basic philosophy of investing and why it matters. Secondly, we'll look at stocks and shares, how they work, and why so many people start there. Third, we'll deal with the most common fears, questions, and concerns around investing. And finally, we'll discuss something I call the alternative path, where instead of only putting the money into the market, you also think about investing in your skills, income power, and business potential. So if you're a complete beginner, stay with me all through because by the end of this video, you have a much better understanding of how to think about investing and how to begin responsibly. Let's get into it. Before we talk about apps, platforms, stocks, or index funds, we need to answer a more important question. What is the real purpose of investing? At its core, the purpose of investing is simple. You want your money to grow so that it can support your future better than it can today. So imagine you have $1,000 saved. You can leave that money sitting in cash. You could keep it in a regular bank account. You could even put it away and not touch it for years. But there's a problem with leaving money idle, and that problem is inflation. Because inflation means the cost of goods and services tends to rise over time. So the same $1,000 that buys you something meaningful today may buy you something less in the future. In other words, even if the number in your bank account stays the same, the purchasing power of that money gradually weakens. But that's why many people eventually realize that saving alone is not enough. Saving is important, absolutely. In fact, good saving tips are the foundation of every strong financial life. But once you've built some financial stability, investing becomes the next step because it gives your money a chance to outpace inflation and increase in value over time. Now, the next big question is this. How does money actually grow when you invest it? In general, investing works when you buy an asset that has the potential to produce value in the future. That value usually shows up in one or two ways. The first way is cash flow. The second way is price appreciation. Let's use real estate as an example. If you buy a property, you may be able to rent it out and receive rental income. That's cash flow. At the same time, the value of the property itself may rise over the years. That's price appreciation. So in that case, the investment can reward you in two directions. It can generate money while you hold it, and it can become worth more when you eventually sell it. The same broad logic applies to many other asset classes. The details change, but the basic principle remains. You put money into something now because you believe it can create more value later. Now, the investing world is full of asset classes. You hear people mention stocks, shares, equities, bonds, real estate, crypto, and many others. Some of these are more stable, some are more speculative, some require large amounts of money, some require advanced knowledge, and some are simply not beginner friendly. That's why for most new investors, it makes sense to simplify the conversation. And the easiest place to begin that conversation is with stocks and shares. Why? Because compared with many other options, stocks are more accessible, easier to research, and available to ordinary people without massive capital. You don't need enough money for a property deposit. You don't need to become a full-time trader. You don't need to gamble on trends you barely understand. You also don't need to be an accredited investor to get exposure to major companies. That doesn't mean stocks are risk-free. Nothing in investing is risk-free actually. But for most beginners, stocks and especially broad stock market funds are one of the most practical entry points. And this is where a leadership mindset matters. A good leader doesn't make decisions out of panic, hype, or ego. A good leader learns the system, understands risks, acts with discipline, and thinks long term. The same is true in personal finance. If you want to lead your financial future instead of reacting to it, you need a strategy. Investing is not about looking rich, it's not about sounding smart. It's not about chasing excitement, it is about building options, stability, and freedom over time. That's the mindset beginners need. Now, let's talk about stocks and shares in a way that actually makes so much sense. When you buy shares in a company, you are buying a small ownership stake in that business. That's what a stock represents. It means you now own a tiny fraction of that company. So if you buy shares in Apple, Amazon, Microsoft, or even Tesla, you're not just buying a random line on an app, you're buying a piece of a real business. That business has employees, products, leadership, profits, expenses, and market value. And if the company becomes more valuable over time, the value of the shares may also rise. There are two main ways investors can make money from stocks. The first is through capital appreciation. This means the price of the stock goes up and later you sell it for more than you paid. The second is through dividends. Some companies share part of their profits with shareholders by paying them cash on a regular basis. That payment is called a dividend. So if you own shares in a company that pays dividends, you may receive money simply for holding those shares. It works a bit like the income side of real estate, except instead of rent from tenants, we receive a share of business profits. Now here's a question beginners always ask. Which stocks should I buy? And this is where things start to go wrong for many people. Because the internet loves stock picking. People want to know the next big winner. They want to find the next Apple before everybody else does. They want the secret stock, the hidden gem, the overnight success. But for most beginners, that is not the smartest place to start. They're not spending serious time researching businesses, reading reports, understanding valuation, and tracking risks. And trying to pick individual winners is usually more speculation than investing. That is why so many experienced voices recommend a simpler path, the index fund. So, what is an index fund? An index fund is a fund that holds a basket of investments and is designed to track a specific market index. In plain English, it allows you to invest in many companies at once instead of trying to guess which single company will perform best. One of the most well-known examples is the S&P 500. The S&P 500 is an index made of 500 of the largest publicly traded companies in the United States. When people talk about the market, this is also one of the main benchmarks they need. If you invest in an S&P 500 index fund, your money is spread across those companies. You don't need to manually buy Apple, Microsoft, Amazon, Tesla, and hundreds more one at a time. The fund handles that for you. And importantly, your money is not split equally. It is outweighed based on the structure of the index. Bigger companies typically represent a bigger share of the fund than smaller ones. And so why is this useful? Because it gives you diversification. Instead of depending on one company, you spread your investment across many companies. That lowers the damage one bad company can do to your portfolio. If one business struggles, you still have exposure to hundreds of others. This is one of the biggest lessons beginners need to understand. You do not need to be brilliant to invest well. You do not need to predict every winner. You do not need to outsmart the entire market. Sometimes the strongest financial strategy is not complexity, it's consistency. And that is why many people choose broad index funds over individual stock picking. They are not trying to be the market, they are trying to participate in the market. Now, how do you actually buy these investments? Usually, you do it through a broker. A broker is a platform or service that gives you access to buy and sell investments. Depending on the country you live in, there will be different brokers available to you. Some offer retirement accounts, some offer tax efficient accounts, and some offer beginner friendly interfaces. Your exact options will depend on your locations, your regulations, and personal goals. So before choosing any broker, do your own research. Look for reputation, regulation, ease of use, fees, account types, and what investments they allow. If you're just getting started, here's a practical beginner framework. First, build an emergency fund. Second, pay attention to high interest debts. Third, learn the basics before putting real money into anything. Fourth, Start small, and fifth, focus on consistency more than intensity. You do not need to begin with thousands of dollars. In many cases, you can start with a relatively small amount. The important thing is not whether your first investment is huge. The important thing is whether you build a habit properly. A lot of people delay investing because they think small amounts don't matter. But that mindset is often the real obstacle. Small amounts invested consistently can build knowledge, confidence, and discipline. And those qualities matter just as much as money itself. Now let's deal with the emotional side of investing because that is where most beginners get stuck. The most common fear is simple. What if I lose all my money? That fear is understandable. Nobody wants to watch their savings go down. But the answer depends on what exactly you are investing in and how you behave when markets move. If you put money into a diversified index fund like the S&P 500, the value of your investment can absolutely go down in the very short term. Markets rise and fall, recessions happen, fear spreads, prices drop. But a drop in value is not the same thing as a permanent loss, unless you sell during the decline. This is one of the hardest lessons for new investors to learn. If the market falls after you invest, it can feel like something has gone terribly wrong. But short term volatility is a normal part of investing. The market does not move in a straight line. There have been periods when markets drop sharply. The financial crash in 2008 is one example many people remember. During moments like that, portfolios can lose a significant amount of value on paper, but historically, broad markets have recovered over time. That's why time horizon matters so much. If you invest money that you may need next week, next month, or even next year, the stock market may not be the right place for it. But if you're investing for the long term, market declines become something different. They become part of the journey, not the end of it. That is why leadership matters again. A disciplined investor leads their emotions, an impulsive investor is led by them. If fear controls your decisions, you will often buy when excitement is high and sell when panic is high. That is the opposite of a strong long term strategy. Another common question is, how much money do I need to start? The good news is that you usually do not need to be wealthy to begin. Many platforms allow small starting amounts. The more important issue is not whether you start with a huge balance or not, it is whether you start with the right habits. Can you save regularly? Can you avoid emotional decision making? Can you stay consistent? Can you invest money you do not need immediately? These questions matter more than the size of your first deposit. Another concern people have is whether they should invest in things like crypto. Now, let's be real. Crypto attracts attention because it promises speed, excitement, and big upside. Some people have made a lot of money in it. A lot of people have also lost a lot of money in it. So, if you're thinking about crypto, the first thing to understand is that it is far more speculative than broad stock market investment. The volatility is higher, the uncertainty is higher, the emotional pressure is higher. That doesn't automatically mean nobody should ever buy it, but if you choose to go into crypto, it should be with money you can fully afford to lose, not your rent money, not your emergency fund, not the money you're dependent on for security. And importantly, crypto should not replace your understanding of real investing fundamentals. Some beginners also ask about government bonds, corporate bonds, real estate, foreign exchange, futures, or even finance. These all belong to different categories of investing and speculation. Some are more conservative, some are highly advanced, some are illiquid, some are unpredictable, and some are driven more by sentiment than stable fundamentals. For a beginner, the smartest move is usually not to try everything. It is to understand one thing well before adding another. A confused investor jumps around. A strategic investor builds layer by layer. Here's another truth beginners need to hear. You don't have to participate in every opportunity. You only need a strategy that fits your goals, your timeline, your risk tolerance, and your discipline. That's what mature management looks. Now, I want to talk about something that often gets ignored when people discuss investing, and that is this. Sometimes the best investment available to you is not the market. Sometimes the best investment is you. Let me explain. Traditional investing is powerful, but for most people, it is a slow process. You save money from your job, you invest it consistently, and over many years, it compounds. That can absolutely build wealth. It can be smart, stable, and effective. But there is another side to this conversation. If you invest $1,000 into a broad market fund and the market gives you average long term growth, that money may grow steadily over time. That's fine. But what if the same $1,000 could be used to increase your skills, your income, or your business capacity in a way that produces a much larger return? That's where a different form of investing comes in. You can invest in your ability to earn. Maybe you use your money to learn a valuable skill. Maybe you take a course. Maybe you get a certification. Maybe you learn sales, coding, public speaking, management, editing, leadership, content creation, or high income service. If that skill helps you earn more every month, then the return on that investment can be much higher than what you'd get from a passive market investment alone. For example, if you spend a modest amount developing a skill that raises your income by even a few $100s a month, your payoff can be dramatic. Not only do you earn more, but you now have more money available to save and invest later. That creates a very powerful cycle. That is why I always say financial growth is not only about cutting expenses. Yes, saving tips matter, budgeting matters, discipline matters, but there is a limit to how much you can catch. There is often much more upside in increasing your earning power. That is where leadership and finance connect in a very serious way. Leaders create capacity, they don't only shrink spending. They improve systems, increase performance, and build future strength. The same principle applies to your personal finances. If you can improve your value in the marketplace, you improve your financial options. Now, let's take it one step further. You can also invest in your own business. Instead of only buying into someone else's company through stocks and shares, you can use time, money, and effort to build something you own directly. That could be a service business, an online brand, a content business, a product company, a consultancy, an agency, a digital asset, or something else aligned with your strengths. Why does this matter? Because business ownership can create a different kind of return. If you build a profitable business, you are no longer relying only on market appreciation. You are creating value directly. You're shaping the system, you are increasing cash flow potential, and in some cases, you are building an asset that itself can later be sold. That doesn't mean business is easier than investing. It usually isn't. It takes work, resilience, leadership, and patience. But for some people, it offers a faster route to wealth creation because the upside is tied to execution, not just market averages. So the big idea here is not choosing one or the other. The smart approach for many people is a combination. Use saving tips to create financial breathing room. Use traditional investing to build long-term wealth. Use self-development to increase your income. Use leadership to make better decisions. And if it fits your path, build or invest in your own business as well. That is a more complete wealth strategy. Because true financial progress is rarely built from one move alone. It is built from aligned moves repeated over time. So let's bring this all together. If you are a beginner, the world of investing can seem full of noise. You hear people pushing stocks, shares, equities, government bonds, corporate bonds, real estate, and all that you can think of, as if one of them is the secret answer. But the truth is, most people do not need more hype. They need more clarity. The purpose of investing is to make your money work harder over time. One of the most accessible ways to begin is through stocks and shares. For many beginners, a diversified index fund like S&P 500 is often easier to understand and manage than trying to pick individual stocks. Short-term market drops are part of the process, not necessarily a reason to panic. If you take one thing from this video, let it be this. Do not let confusion keep you frozen. You do not need to know everything before you begin. You just need to start with a sound foundation, a clear strategy, and the discipline to stay consistent. Here on Doxalin, we focus on building that kind of mindset through financial strategies, practical saving tips, and stronger leadership. If this video helped you, make sure you subscribe because we've got more content coming on money management, wealth building frameworks, smart habits, and how to become more effective in both your finances and in your life. And in your comments, I want to hear from you. What is the biggest concern about getting started with investing? Is it fear of losing money, not knowing where to begin, confusion about stocks, index funds, or crypto? Or are you more interested in the path of investing in your own skills and building income first? Drop your thoughts below and let's keep the conversation going. This is Linda Daisy Adams, and thanks for watching those. I'll see you in my next video. For now, bye.